Hey, what's up you guys? It's Kyle with No BS Investing. Now over the last few years, car prices have gotten out of control. If you've been in the market, you would have noticed that this didn't just affect new cars. Used car prices also spiraled out of control. So what does this mean for you? Will prices just keep going up, or will they come back down to reality? Have you tried buying a car recently? If you have, you probably noticed something shocking. Prices are out of control. New, used, every model seems to be hitting record highs. But guess what? This crazy market is finally starting to cool down. Today, we're breaking down how prices got so high, why they're finally dropping, and what it means for you. Whether you're buying now or waiting it out, you need to hear this. Let's rewind a bit. How did we get here? The car price bubble wasn't caused by just one factor. It was a result of a perfect storm. The Rona pandemic wreaked havoc on the global supply chains, particularly in the automotive industry. Factories shut down, microchip shortages crippled production, and suddenly new cars became a scarce commodity. The scarcity drove prices up, as demand for new vehicles remained strong. With people stuck at home, the demand for personal vehicles surged. Whether it was for road trips or avoiding public transportation, everyone wanted their own set of wheels. The fear of public spaces during the pandemic, coupled with the desire for private controllable environments, made cars a hot commodity. Central banks worldwide slashed interest rates to stimulate the economy, making financing a car more affordable than ever. This pushed people into the market, further driving up prices. Low borrowing costs meant consumers could afford higher monthly payments and even more expensive vehicles, which in turn inflated prices across the board. With the rise of platforms like Carvana and Vroom, buying a car became as easy as ordering groceries online. The shift increased competition, pushing prices even higher as dealers and sellers realized they could reach a broader audience. The convenience of online shopping and the ability to compare prices easily led to increased pressure on inventories, pushing prices up even further. But as with all bubbles, this one couldn't last forever. Here's how the bubble finally popped. As global economies began to recover, inflation surged. The cost of everything went up, including cars. However, wages didn't keep pace, and people found themselves unable to afford the skyrocketing prices. This disparity between the rising costs and stagnant wages created a tipping point where demand began to fall off. To combat inflation, central banks started raising interest rates. Suddenly, that cheap car loan wasn't so cheap anymore. The cost of financing a vehicle increased, causing many potential buyers to step back. Higher rates meant higher monthly payments, reducing the number of people who could afford to finance a new vehicle. As supply chains began to stabilize, car manufacturers ramped up production. More new cars hit the markets, easing the scarcity that had driven prices so high. The used car market, which had been red hot, started cooling down as more people could finally buy new. This increase in supply began to outstrip the decreased demand, causing prices to drop. With higher prices and rising interest rates, demand naturally fell. Car lots that were once empty started filling up again, and sellers who once held all the cars now found themselves with too much inventory and not enough buyers. The sudden shift in market dynamics forced sellers to lower prices to move their stock. Let's take a closer look at the numbers driving these changes. As of January 2024, the average price for a new car was $47,401. This marks a 3.5% decrease from the same time last year, reflecting the easing of inflated prices as inventory levels improved. This significant drop highlights how the market is correcting itself after years of excessive pricing. Car manufacturers, recognizing the shift in the market, have increased incentives to entice buyers. These incentives now account for 5.7% of the average new car sale, nearly double from the previous year. The competition to attract buyers has driven automakers to offer better deals, further pushing prices down. Another crucial indicator of the health of the market is the day supply of vehicles. As of June 2024, this figure stood at 74 days, a substantial 43% increase from the year prior. This means that if the dealer stopped ordering new vehicles now, it would take 74 days for them to sell off the entire lot. The rise in supply reflects the growing availability of new vehicles, which has helped to bring prices down. With more cars available, buyers have more choices, reducing the pressure to pay top dollar. The total inventory of new vehicles in the US reached 2.96 million units by June 2024. This influx of available cars represents a 55% increase from the previous year, illustrating the dynamic shift from scarcity to abundance. With so many cars available, dealers are now more willing to negotiate, leading to lower prices and better deals for consumers. The bursting of the car bubble isn't just affecting car buyers and sellers, it's rippling through the entire economy. With prices falling and interest rates rising, the auto loan market is feeling the strain. Lenders are tightening their standards and fewer buyers are qualifying for loans. This could lead to a major slowdown in the auto financing sector, as fewer people take out loans for new cars. Auto manufacturers who once enjoyed profits during the bubble are now facing a different reality. With the prices stabilizing and demand decreasing, they must adapt to a more competitive market. This might mean more emphasis on electric vehicles, cost-cutting measures, and rethinking production strategies to align with the market dynamics. As the prices start to stabilize, consumers are likely to become more selective. The trend of buying the latest vehicle model every few years might give way to longer ownership periods. Leasing could also see a resurgence as buyers look for ways to manage costs. Additionally, the used car market, which saw a huge boom during the bubble, may start to slow down as more buyers can afford new vehicles. As car prices soared, many consumers took out larger loans with longer terms. Now with economic pressure mounting and interest rates rising, the delinquencies of auto loans have started to increase. According to the New York Fed, the rate of serious delinquencies, 90 days or more past due, has climbed, reflecting the strain on household finances. And the delinquencies mean that people simply stopped making their payments on their car loans. This trend could have significant implications for the auto finance industry and the broader economy. So what's next for the car market? Here's what we can expect. With increased inventory and rising supply, car prices are expected to stabilize. While drastic price drops are unlikely, the days of rapid price increases are over. The market is likely to find a new equilibrium, with prices reflecting a more balanced supply and demand dynamic. Consumers are likely to become more cautious with their spending. Leasing might become more popular again, and people might hold on to their cars for longer, reducing the frequency of new purchases. The emphasis may shift towards fuel efficiency and long-term reliability as buyers look for value over luxury. In long term, car manufacturers will need to adapt. The days of relying on high prices and scarce inventory for profits are over. We'll likely see more competitive pricing and incentives to attract buyers. Additionally, the push towards electric vehicles and sustainable practices may accelerate as automakers look for new ways to differentiate themselves in a crowded market. Over the next few years, the car market is likely to undergo significant changes. In conclusion, the car bubble has burst, but it's not all bad news. A more stable market could mean better deals for savvy buyers and a return to normalcy in an industry that's seen its share of turmoil. If you're in the market for a car, now might be the time to keep your eyes open for opportunities. Thanks for watching. If you found this video helpful, please make sure to hit the like button, subscribe, and leave a comment below. I'll see you next time. Thank you.